Hello and welcome to Module 1 of the Stock Market Masterclass, Fundamental Analysis. In the first part of the Fundamental Analysis module, we will look at how investment markets operate through an economic cycle, and isolate the investments that traditionally perform well at different phases of the cycle. In this lesson, you will learn what an economic cycle is and the different phases of the cycle, the key measures of the economic cycle, the investments that perform well in the first half of the cycle, and finally, the investments that perform well in the second half of the cycle. Let's first look at economic cycles. Also known as a business cycle, an economic cycle is best explained as the fluctuation of the economy during periods of expansion and contraction. There are four phases of the economic cycle: expansion, peak, contraction, and trough, with the length of one cycle measured from one peak to the next peak. Cycles in that period have historically been as short as 18 months and as long as the current cycle in 2019, which has been running for close to 10 years, since 2009. It is important to note that from the last peak in March 2009, this current economic cycle is one of the longest periods of economic growth on record. Let's now look at the four phases of an economic cycle. The first phase is the expansion phase. The expansion phase of a cycle is based on consumer spending contributing to the growth of the economy. Aside from the general spending such as groceries and healthcare products, which are required regardless of the state of the economy, purchases of larger ticket items like houses, cars, and non-essential investments make a significant contribution to the health of the economy. Economic growth drives up the demand for new employment and new business, which increases competitiveness amongst retailers and helps fuel consumer spending. The next phase of the cycle is peak. When the economy begins to reach a point where business productivity and output begins to slow, businesses will still generally be thriving, but they start to experience costs and pressures that weren't there at the start of the expansion phase. The cost of skilled labour will generally be higher due to demand, and competition will be fiercer due to the new businesses across all markets vying for the same customer. Central banks usually get concerned about inflation in a booming economy, and as such, begin to raise interest rates to mitigate the inflation risk. This puts extra pressure on businesses who have to pay more for the money they borrow to operate, and on consumers who have to pay more in interest when making large purchases like property. The next phase of the cycle is contraction. During this phase, consumer purchasing drops, which causes businesses to reduce production to try and remain competitive. A fall in production levels then leads to a reduction in employees to remain financially viable. Because employees are an easy cost reduction for business, employment numbers tend to drop early in the contraction phase. It is because of this early signal that non-farm payroll job numbers is considered one of the most important news releases. Non-farm payroll covers the employment segments of goods, construction, and manufacturing employment, not including farm workers, and is released on the first Friday of each month for the previous month. Central banks will then begin to lower interest rates to try and stimulate consumer spending and business expansion in an attempt to bring the economy out of recession. The final phase of the economic cycle is the trough, and this is where companies have reached a point of desperation and begin to lower prices to get rid of any inventory and once again increase their cash flow. When the weight of the companies and businesses drop their prices, consumers are enticed to start spending again, and with the combination of low interest rates and cheaper house prices and appliances, consumers who have been putting off purchasing start to spend money. Just like employment numbers, new housing starts is also a crucial report that investors pay close attention to, especially during a recession where they are attempting to identify the bottom. Let's now look at the key measures of an economic cycle. There are a few key measures of an economic cycle investors need to be aware of, and we will now break down some of the most important of these with an explanation on how each relate to the economic cycle. First, let's look at the gross domestic product. The economic cycle is directly linked to the gross domestic product, also known as the GDP, the monetary measure of a country's market value of all the final goods and services produced in a defined time period. GDP numbers are expressed as a percent and are released quarterly, acting as a measure of how the economy of each country is tracking relative to its forecast and previous results. A GDP number that is rising signals the economy is still growing, as the market value of goods and services that a country is producing is increasing. A stagnant GDP number can signal a flattening or topping of an economy, and a falling number signals a decline in the country's production output, which often signals the end of the growth phase. It should now be easy to understand why so much emphasis is placed on GDP numbers, as this has a direct relationship with the health of the economy. Now let's look at inflation. Inflation is a measure of the rate at which a price level of goods and services increases over a period of time. Inflation is measured as a percentage of the consumer price index, also known as CPI, and can be seen as a rate of change in price from one period to the next. As an example, consumers often notice that the price of a household good increases from one year to the next, but the same dollar amount spent results in less goods in the previous year. See in the example on the screen how $1,000 was able to purchase 3 tons of grain in 2018, but the same dollar value was only able to purchase 2.5 tons the following year. Now the opposite of inflation is deflation, and this is where the cost of goods and services falls from one period to the next. Many economists maintain that a zero to slight increases are the best outcome for inflation for a healthy economy, as rising inflation directly affects the cost of living. If rising inflation outpaces an increase in wages, consumer spending will decrease, which negatively impacts the health of the economy. It is easy to see why, particularly during times of economic expansion, the measure of inflation is closely monitored by the central banks and governments to ensure that it doesn't jeopardize the growth of the economy. Now let's take a look at interest rates. All things equal, interest rate cycles generally mirror economic cycles. Interest rates are a mechanism that the central banks use to slow down a growing economy and rising inflation. When the economy is growing at a fast pace, the central banks can raise interest rates to slow down the growth of the economy and reduce the risk of higher inflation. A rise in interest rates means that consumers will slow down their spending and businesses will slow down their expansion as their borrowing costs will increase, effectively slowing down the growth of the economy. At the other end of the scale, lowering interest rates can be used by the central banks to stimulate a flat or unhealthy economy. Lowering interest rates gives consumers access to cheaper borrowing costs to purchase big-ticket items like houses and cars, while businesses can use the cheaper borrowing costs to expand, generating an increase in production output and employment levels. Now let's look at employment numbers. As I mentioned earlier, employment numbers play an integral role in the health of the economy. More specifically, the unemployment numbers are expected to rise and fall as the economic conditions change. When the economy is healthy, unemployment numbers would be expected to fall, as companies are expanding and putting on more employees. In an economy that is weak, the opposite is true, where businesses attempt to reduce operating costs by putting off employees. Unemployment data is treated as a lagging indicator, which effectively means that changes in the unemployment rate don't precede the changes in the economic cycle. Whilst this is true with outlier results, consistent increases or reductions in unemployment levels over a period of time help confirm an end to the peak phase and the start of the trough phase. Another important consideration is that the share market generally precedes the economic cycle by 3 to 6 months. This means that the share market can turn bearish considerably faster than an economic cycle reaches its peak. So although unemployment data may be a lagging indicator of the economic peak, it could prove very useful to help identify a share market peak. Now we'll talk about consumer spending. At the heart of all growing economies is consumer spending. When consumer spending is at a high level, businesses are thriving as demand is generally exceeding supply. This has an on-flow effect where businesses can charge more for their goods and services because of the increased demand, which raises their profits. Consumer spending is also a reflection of consumer confidence in the country's economy, as weaker consumer sentiment is not beneficial to a growing economy. Consumer spending makes up a significant part of the overall GDP, so it is easy to see that rising levels of consumer spending will help increase the GDP level. Therefore, falling consumer spending levels have a negative impact on a country's GDP and can help signal the slowing or turning point of a growing economy. Let's now look at the first half investment performance. So far, we have learned that the economic cycle has 4 phases, so it would make sense that certain investments in the share market would perform differently at each of the different phases. The next section focuses on the first stages of the economic cycle and identify some of the better investment performers at the early stage. Let's first look at trough phase investment performance. It is at this stage that the market is recovering from a recession, so interest rates are still generally falling, which will add money flow and liquidity to a weakened economy. This will boost company earnings, as money will be cheaper to borrow, allowing businesses to expand and increase production. Cheaper borrowing costs also gets consumer spending more, which will help kickstart the economy. The investments that traditionally perform well in this phase are financials, as the appetite for borrowing increases from both consumers and business. Another investment group that traditionally performs well are consumer cyclicals, a group of industries that thrive in an expanding economy. This category of industries includes entertainment and retail, as consumers have been holding off on purchasing until prices were low enough to warrant the extra spending. The other group of industries that perform well are housing and automotive. The cheaper borrowing costs, coupled with companies lowering prices to reduce inventory, create a perfect environment for consumers to resume purchasing the bigger ticket items. Now let's take a look at the expansion phase investment performance. During this phase, the economy is already starting to grow, with the corporate earnings at their highest levels due to increases in demand and low interest rates. With consumer confidence already increasing as the fear from the last recession subsides, the future is looking bright for investors, who will be starting to look at the longer-term opportunities. The investments that traditionally perform well in this phase are industrials like development and infrastructure companies, logistics and manufacturers. These industries generally expand during this phase due to the increase in business activity and government spending, and with that expansion comes greater profits. Information technology is another area that performs well in an expanding economy, as demand for new and improved technology increases, and in turn helps lower unemployment levels due to the greater productivity. Commodities is another group of investments that can appreciate in value during an expanding economy. Basic materials like gold, copper, and oil have a strong history of outperforming the general market at times of economic expansion due to increased manufacturing demand and growing infrastructure projects. The price of commodities is generally driven by supply and demand, so it is easy to see why this group of investments can perform well in an expanding marketplace. Let's now have a look at second half investment performance. The next section focuses on the latter stages of the economic cycle, when the growth is starting to waver and consumer spending and confidence begins to decline. Let's look at the peak phase investment performance. At this point of the economic cycle, the market begins to look overheated and extended, and concerns of a recession start appearing in the news. The share market begins to look expensive, and inflation is on the rise. The industries that tend to do well in this phase are energy and utilities. The demand for services that industries provide don't decrease dramatically from a consumer standpoint, as people still need electricity and gas to survive. Healthcare and consumer staples are other industries that tend to outperform the general market, because once again, consumer demand remains in place, regardless of share market performance and talk of recessions. Companies in these sectors have a strong history of consistent performance at times of market weakness, and are also known as defensives for this reason. Let's now look at the contraction phase investment performance. The final phase sees economic activity start to dry up, and company profits are already declining, causing an increase in the unemployment level and dropping consumer spending. Interest rates are generally at high levels, and the share market has more than likely seen a large correction and may already be bearish. For the same reasons outlined earlier, energy and utilities, as well as healthcare and consumer staples, are traditionally the favoured investments in a contraction phase due to their defensive properties. It is important to note that the contraction phase, also known as a recession, has historically lasted considerably less time than the expansion phase, and is generally no longer than a year. It is during this time that investors need to be on the lookout for the signals of the next phase starting, the trough, to start preparing for investments that perform best at the beginning of a new cycle. In this lesson, we have learned what an economic cycle is and the different stages of the cycle. We learned about the key measures of an economic cycle. We learned about the investments that perform well in the first half of the cycle. And finally, we learned about the investments that perform well in the second half of the cycle. This concludes section 1 of the Stock Market Masterclass Fundamental Analysis. In the next section, we will learn about sector analysis and industry health, and how understanding this information can help strengthen your portfolio.